5 investing principles that helped me retire at 39 with $1 million. 1. Time is your friend. It takes time to make money in markets. You may get lucky and buy at the bottom of a bear market, but this is somewhat uncommon. More likely, you will buy closer to the top of a bull cycle when excitement is high and face a drawdown. I started investing in 2006, right before the global financial crisis, and saw my money get sliced in half 2 years later. It took 5 years for the market to reach all-time highs again, and today the market is 10x the low made in March of 2009. If someone had started dollar cost averaging into an index fund for the last 16 years, he or she would be doing very well today. The lesson here is that time is the best hedge against losses in the stock market. Riding it out often results in total recovery as well as fantastic returns. 2. Do not keep your head in the sand. It's best to not pay attention to financial news and fluctuations of the markets. However, there are times when opportunities present themselves. Large sell-offs, like the COVID crash in 2020 and Liberation Day in 2025, present rare buying opportunities. Buying during these times can significantly boost your compounded rate of return in the long run. The markets usually overshoot significant events, and an investor should be brave and capitalize on those overreactions to make a fantastic return. 3. You must take enough risk to capture a decent return. I'd say there is a problem with not taking enough risk when you start your investment journey, especially if you are in your 20s or early 30s. The standard 60-40 portfolio has generated about a 7% return over the last 20 years, compared to the 100% stock portfolio, which generated about a 10% return. 3% difference results in an almost 60% return gap between the two strategies over a 20-year period. Granted, you may want to accept a lower return with the 60-40 portfolio to reduce volatility when you are 60 and older, but it appears that a 100% stock portfolio may be the best option for younger investors. 4. Don't be afraid to adjust. In late 2021, I had a $200,000 bond position consisting of bond ETFs such as TLT and BND. The 10-year note was sub 2%, while CPI reports were printing inflation of over 6% in late 2021. It was clear as day that I needed to take action, so I sold my entire bond ETF portfolio and invested it all into US equities. I got hammered during the bear market of 2022, but so did many balance fund portfolios. Fortunately, the stock market recovered in 2023 and 2024, while bonds are still in a bear market. It's best not to time the market, but there are instances where you have to make a decision, and inaction could cost you a significant drawdown. Albeit, the same argument could be made about going to a 100% bond position in 2007. All in all, timing is very difficult, but it may be best to make some gradual adjustments, and the fundamentals of the economy are screaming obvious signs of trouble. 5. Do not chase. I bought Bitcoin in late 2021 at around 50,000. Over the next 6 months, it fell to 30,000, at which point I sold it all. It eventually fell to 16,000, but today it's around 120,000, and I would have more than doubled my investment had I not sold. But what I am really mad about is that I could not resist the fear of missing out I felt from the run-up in 2020 and 2021. It seemed like everyone and their dog had Bitcoin and crypto, and they all were making me feel like a clown because I was sitting out while they got rich. The moral of the story here is to be extremely patient with an overheated market. Dollar cost average if you can, and leave big purchases when the price is down 20% or more. Try hard to resist FOMO, because when everyone, including the Uber driver, is talking about a market, it's probably due for a large correction, which then after it happens, you can buy at a better price. Those are my 5 investing principles that helped me save $1 million by 39. Please comment, like, and subscribe if you enjoy my content. Thank you, and have a nice day.